All right, what is up, tycoons, or what's up, traders? Super excited for today's video. We got to talk about how the stock market recently went oversold, how things have been more bearish than in at least a decade. And this is the most important chart right here from Worth Charting. We're going to break this down a lot more in today's video, go over why it's so important, why I think it's the most important one. Tax season, I think that this is a big reason we saw a large sell-off. I went over this in my last video, and it's something that I really think contributes to it. We'll break that down some more, go over seasonality, and what we could potentially be seeing for the rest of the year looks very bullish. Maybe not so bullish at the moment. We'll go over my Elliot wave count that I've got for the S&P 500, how it aligns with seasonality, how it aligns with historical data, break all of that down for you guys. And then we'll go over some more historical data, going over election year drawdowns. We'll take a look at the different type of drawdowns that we've seen in election years. We'll talk about what if the Fed changes course, financial conditions, cyclicals versus defensives, crude oil, the whole no landing expectation, money market funds. We'll talk about the top 25 stocks that you guys may want to pay attention to. We'll go over where we're at in the S&P 500 in terms of momentum, direction, and trend. We'll take a look at equity fund flows, and then we'll touch on earnings, right? And it's a big earnings season. Meta was a disaster. We saw the stock tank. All right. We saw Tesla rage. We're now seeing Google rage. We're seeing Microsoft up in the after hours. PCE comes out tomorrow morning, Friday morning. Okay, so that's going to be a big impact on the market. We will continue to talk about earnings, and then we'll talk about Exxon. They also have earnings Friday here as well. Really interested to see what they have to say for the energy space, as I've been pretty bullish on energy for 2024. Then, of course, we will dive into bonds. Okay, we'll talk about how equity valuations look less attractive as yields surge, what I'm seeing on TLT, and then what I'm seeing on the TNX. So it's going to be a really good video. You guys are going to want to watch to the end so you don't miss any of the analysis or data in today's video. And don't forget to smash the like button and subscribe to the channel. But as always, the content provided is for informational and educational purposes only. It's not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. And if you're new to the channel, I started a newsletter for you guys, completely free. You can sign up for that using the link in the description, giving out free, valuable finance and trading content. There's a website associated with it too, so you can go back and read some of the previous newsletters, trade ideas, content, different things like that. There's also the Investment Intelligence Discord. It's $10 a month. You guys can join that. And that's where you'll get access to all my analysis, all my different trade ideas, different data. Okay, so all the data that you're seeing in the videos, they're all posted in the Discord now ahead of time or as the videos are being uploaded. So if you want to save some of these charts or some of these different data sets, not only will that be available, but there's many other resources such as valuable, custom scripts, indicators, being able to see gamma levels, dark pool levels, many other things. Hey, here's some examples of some previous trade ideas in the last month. We had Tilray was a really nice one, a 3-to-1 risk to reward ratio here. Ended up going way past our 3-to-1 price target. The runners there, because after you hit your profit goal, you take profit and you leave some runners. The runners went up a lot on Tilray. Energy is something we've been paying attention to a lot in 2024. Valero was a really great play. Talking about the entry here with a 2-to-1 risk reward back when it was in the 140s, the stock exploded past 180. You can see the runner there went up tremendously as well. Now let's get into the video and talk about how the stock route drove the S&P 500 to oversold territory here recently. And corporate buybacks have been rising. Okay, Google actually just announced corporate buybacks today. One of the reasons that the stock is up so much, but when you take a look at executives, they've been dumping stock, okay? And when you take a look at the 10-year average, this is the most bearish that executives, right? Using the context from executives selling stock, this is the most bearish that we've seen in at least a decade. And that's part of what has led and helped lead to this S&P correction that we've had. We've corrected over 5%. We're starting to get a little bit of bounce. But here's what happened, guys. Here's what's really important is that the average magnitude of a 5% plus correction is almost 12%. Okay, so it's over 11%. And the median magnitude is going to be 8%. All right. Now, the average duration of these 5% plus corrections is going to be 38 days, with the median being 21 days. So just think of it like this. Historically, right? What do the numbers say? Not what some guy on YouTube says, not what your friend says, or your favorite social media influencer says. What do the numbers say? Well, they say that if we peaked at all-time highs, we're most likely going to have a correction that's going to last between 21 and 38 days. Okay, so let's just call this, 3 to 6 weeks. Okay, let's just say something like that, 3 to 6 weeks. All right, so then we'll go ahead and take a look at when the stock market peaked, and we'll try to time that up, right? We're not going to be perfect investors. We're not going to be, perfect traders that catch the exact bottom every single time that we make a trade, right? But we can use this data to say, hey, now that we've seen a 5% correction, has it been 21 days? Has it been 38 days since the all-time high? If so, maybe we want to start nibbling, right? That's one factor. And then you take a look here and you say, well, each time that we get a 5% correction, it doesn't stop there. Here's the big difference, people, between, a correction and a pullback, okay? A pullback is just a little bit of profit taking so you can continue to go higher and new buyers step in and we continue to make new highs. A correction, it gets that bounce that a pullback does, but it's followed by lower highs. That's the whole difference, is you get lower highs in a correction and then the rest of the sell-off continues. Okay, that's what I'm personally expecting. Okay, that may not be what happens. We may, break through this and the rest of earnings may continue to be good and the stock market may make new all-time highs and we simply just got a pullback. But if we are getting a correction, I do think that, we're going to see, based on data, right, that we're going to see some type of 8% to 11, maybe 12% correction, and kind of just using that as a guideline, right? Maybe we only correct 6 or 7%. Maybe we correct 12 to 13, 14%. Who knows, right? But I'm not saying that this is the top and we're now entering a new bear market. Now, tax season is one thing that I really think is a big impact. Okay, I know I sold stocks for, I took money out of my account to pay taxes for tax season, and I'm sure that a lot of people that didn't want to sell at the end of 2023 because they didn't want to have to pay taxes for 2023, now it's time to pay those taxes. And a lot of them, if they invested in 2023, especially early in the year, they still are sitting on very significant gains, right? So they can take some of their profits and put that towards the taxes that they perhaps need to pay. Tax season forced a $300 billion liquidity drain this year. Now, combine that with election year seasonality. So 2 seasonalities on this chart. Black is going to be every single election year, okay? The seasonal average of the stock market for every single election year. You can see it's bullish, okay? And that makes sense, right? If someone's running to get reelected, they want the stock market to be doing well. The only times that the stock market has not been positive and we have not seen a gain in an election year is when a recession has also occurred during an election year. Okay, and this is something I brought up before months and months ago in the past, in the very beginning of the year. And so the big question you have to ask yourself if you're a bear is, hey, are we coming into a new bear market, right? That's the decision. Are we going to see a 20% correction in the market and enter a new bear market this year? If you think that, well, then maybe you don't want to invest. But if you think that we're not going into a bear market, specifically in 2024, if we're not going to see a bear market, then the stock market is going to finish higher, okay? I don't have the data set with me, but DataTrek has done really amazing work. You should check out their YouTube channel, all right? They're one of the, top data analysts out there, really, really great, institutional grade analysis. And they've highlighted how 60 to 70% of all-time highs, they occur in December. Do you know why they occur in December? Because the stock market continues to go up on average over the long term throughout the entire year. The only times we peak in January are whenever we're actually entering in bear markets or seeing some type of crisis, okay? So just use the data to help back you up, right? And don't focus so much on, oh, well, these valuations don't make sense, or, this and this and this. The macro factors, while it's important to pay attention to, Warren Buffett is very famous for saying that, if you have an economist on staff, you have one too many employees. Okay, that's not the exact quote, but that's the gist of the saying. And the green line here is going to be the top Q1 election years. Okay. So this is the black is all election years. The green is the top performing first quarter. And that's what we had, right? We had an amazing first quarter that really could have, the stock market could have went flat for the rest of the year. And investors on average would have still said, hey, this was a great year for the stock market, okay? Because it was positive and we were up 10%, on the year just in the first quarter. But take a look at what happens during these top Q1 election years. You see a big sell-off here, okay? You see a big sell-off between April and June. We saw something similar last year, okay? And it was rather, we saw a sell-off in the summer. Here, this is kind of suggests that we'll see a spring sell-off, okay? Now, this isn't something to live or die by, but it's something that I take into account, right? And I've taken into account ever since 2022, October, when it said that the stock market was going to bottom in October of 2022 via midterm election year seasonality. I was a little skeptical, but I said, hey, I'm going to try this out, bought a couple long positions, and that ended up being the bottom of the bear market. Okay, I'm sure there were other factors, and it wasn't just because it was a midterm election year, but there was a 100% win rate if you buy after the day after midterm elections, 6 months to 12 months out. That record is still standing. So keep that in mind for future reference. But what I want to highlight is how I think that we're in this correction phase. Okay, now we're not going to get too deep into Elliott wave analysis, but just understand that the market typically moves in 5-wave and 3-wave structures, right? So you have a 5-wave and a 3-wave. So your 5-wave structure, that is going to be, your impulsive move, your impulsive structure, your main trend. And so from that bottom in October 2022, I think we're in a 5-wave structure, okay? And we just hit wave 3, the top of wave 3, and we're in wave 4 now, okay? Remember, the market comes in these 5-wave and 3-wave structures. Your wave 2, okay, which is a correction, and your wave 4, which is a correction, are going to come in those 3-wave structures in the form typically, not always, of an ABC. So you see an A wave down, a B wave up, and this is what I meant by a real correction sees a high and then a lower high, and that's how you know it's a real correction. We saw the same thing in the wave 2s of our sub count and our primary count, right? Over here, we saw ABC, right? Over here, we see an ABC, right? Same type of, setups in different scenarios that we're getting in the market, okay? And so, we have 1, 2, this is 3, okay? Wave 3 may look, you're like, wow, how does he decide that this is wave 3 all the way up here? Well, wave 3 is always going to be your most impulsive and generally the strongest move, okay? And the largest move. It's very common to see that. And so, in this wave 3, your wave 3s are going to be 5 waves. Okay, so wave 1 should be 5 waves, wave 3 should be 5 waves. Wave 2 should be, 3 waves ABC, wave 4 should be 3 waves ABC, wave 4 should be 3 waves ABC. And, it appears that we hit the A wave. Now, the big question is this the bottom of wave A? And are we officially in wave B? If the market doesn't sell off because of PCE tomorrow and inflation numbers, then I think that we continue this wave B up, okay, and then we ultimately end up putting in a lower high to come back down lower towards 4,900 to about 4,800, okay? This is where I'm setting my expectations at right now. We can't get the exact levels or Fibonacci extensions or, levels until we, put in a base or a top for wave B, okay? So that's what I'm looking at right now. Does that follow up with this? Well, let's see. What do we see? We see a wave down here on the green, a B wave up, and then we see a C wave down, a bottom, right? And so let's see here. Well, A, B, C, right? It follows up pretty well with seasonality. So that's what I'm paying attention to right now. This is my thoughts, my opinions, right? And where I think market's going to go. I may be wrong. I may be completely wrong. But I love a lot of what the data says. Now, there's plenty of big election year drawdowns. Okay, so a drawdown is much different than a bearish market. Okay, some of these did end up in bear markets. Okay, 2000. We all know the dot-com bubble. We know 2008. Right, we see big significant drawdowns in those. You have 2020 big drawdowns. But what I want to highlight is, on average, you're going to see about a 13% correction. Now, the smallest is 3.5%. Now, the largest is 48%. Okay. And so that's what skews a little bit of this data towards that 13%. When we let's say we were to take out that 48%, most likely we would be a little bit closer towards that 8 to 11%, 8 to 12% that we typically see once the market has a 5% plus correction. So again, that's kind of where my mind is at, is that we could see anywhere from about an 8% to about a 12% correction if this is an ABC setup and if we're not heading to all-time highs off of the most recent lows that we put, right? If we break the most recent lows, those are my expectations, somewhere around 8 to 12%. And I think that you can start to manage risk pretty well, looking for some long positions in those areas once we get there. But it's all about your own time horizon and your own risk management. Now let's continue moving forward. What if the Fed changes courses? What would the 2-year Treasury be? Okay, the yield on the 2-year Treasury, it's currently right around 5%. Okay, if the Fed was to move a lot slower, aka that higher for longer everyone keeps talking about, most likely we're going to see the 2-year Treasury up above 5%, near 5.2, near 5.25. And if the Fed cuts a lot sooner, a lot faster, we're going to start to see the 2-year yield drop, and that's going to result around 4.5%. That's from Liz Young over at SoFi. Now, financial conditions have been tightening, right? And they've tightened since the last FOMC meeting. It's not a coincidence that we're seeing financial conditions tightening and the stock market pulling back, right? You can see that via different financial condition metrics and indexes, but we're seeing a large spike in financial conditions here as the stock market's pulling back. This is what the Fed wants to see ultimately, right? Is the Fed does want to see financial conditions get tighter so that eventually they can loosen Fed policy. Now, as this chart goes up, it means that cyclicals have been outperforming. And as this chart goes down, it means defensive has been outperforming. We've seen a big sell-off, right? We're seeing financial conditions tightening. We're seeing defensive outperforming as this chart is going down here. And so all of this just kind of justifies, hey, yeah, this is a standard pullback, right? We're seeing what normally happens during a pullback. We're seeing financial conditions tightening. We're seeing defensive stocks outperform cyclical stocks. It's very common to see. So there's nothing crazy, nothing out of the ordinary about this pullback. And what really sparked off the large sell-off was inflation, okay? And energy has a big impact on inflation, and I think it's a valuable hedge that you guys need to be paying attention to is energy and commodities. If you've been up to date with the channel, you've been up to date on the newsletter, it's something that I've been pounding the table on in March and April. And it's something I just think that you guys want to keep aware, right? I'm not saying you need to sell all your stocks and buy only energy stocks or sell all your stocks and only invest in commodities. But if these things continue to rise, okay, and these stocks, these futures, the price of these different agriculture and commodities and metals and energy, oil, gasoline, if all these things continue to rise, that's literally inflation. That's the definition of inflation. Prices are going higher on goods, okay? Not just services, but these are goods that we're looking at. And that's going to be bad for stocks. It's going to be a hawkish Powell, a hawkish Fed, and most likely we're going to see more drops in the stock market. So you need to pay attention to these things. And really, take a look at the crude oil impact has on core inflation, okay? That's what you want to be paying attention to. Now, expectations for no landing have been surging, right? There were a lot of expectations for a soft landing, okay? That's the light blue here. So you can see the vast majority of people, when we bottomed in October of 2023, we saw that this was rising. And then in October 2023, we went the most bearish we did when it comes in terms of a soft landing at 59%. And ever since then, we've been on a very strong uptrend here. And look what's getting smaller and smaller, a hard landing. Okay, so hard landing is getting more and more taken out of the picture. And no landing at all is really the one that's starting to rise. That is the one that's surging here. It's like, hey, maybe we're really just not even going to get no landing. Okay. And this is a survey of what is the most likely outcome for the global economy over the next year. Now, there's still tons and tons of money in money market funds. And I want to clear something up that a lot of people think that this money is just magically going to flow into the stock market. People say, oh, well, there's all this money on the sidelines. Money on the sidelines is money on the sidelines. It's just that, right? It's completely different from investable money, in my opinion, right? I'm not saying that you can invest it or that money market funds are an investment, but people treat that money on the sidelines as money on the sidelines, right? Maybe emergency money. Maybe, hey, if there's a huge stock market dip, maybe some people will pour in. But think about this. If the market is correcting 20% and you're still able to get 5% in your money market fund, are you actually going to take your money out of your money market fund and put it in a stock market that's going down when you're getting a risk-free 5%? Or are you going to leave that money in there, right? And so this yield, right, is just compounding on top of each other. It really, this chart just looks bullish. Okay, whether it's institutional, whether it's retail, there's over 6 trillion in money market funds right now, and that's something that honestly is good, right? It's nice that people can actually get money, right, on their cash and actually receive money on their cash. And I'm here for it. Honestly, I mean, you shouldn't have to. You should have other forms besides just stocks that really offer some type of return. And it's nice to see treasuries and it's nice to see money market funds giving people a way to do that, right? Now, if you guys want to take a screenshot of this, this is StockTwit's top 25 in the S&P 500. And these are some interesting names in here, okay? We see some really interesting names from Disney, Micron. We see Eli Lilly, United Airlines, Kroger, NVIDIA, of course. We see even Super Microcomputer, even after its massive sell-off it had here recently. Lots of different stocks, right? And so these are some names that you guys can pay attention to. What we're looking on this chart is basically going to be a measurement of trend. So if I get my big head out the way here and just scoot it over a little bit, you can see the S&P 500 pulling back here, right? And this chart may look a little weird. Let's break it down. So the green is going to be the percentage of stocks above both their 200-day moving average and their 50-day moving average. Orange, percent of stocks above their 200-day but below their 50-day average. And then red is percentage of stocks below their 200-day and 50-day moving average. So, you see in October 2023 here, the red was very, very high, okay? Very high. Many stocks were trading below both their 200-day and 50-day moving average, right? It hit extreme levels, and shortly afterwards, we bottomed. Now, what do we see here most recently? In late March, early April, we see that we hit an extreme on the percentage of stocks above their 200-day and 50-day moving average, and that has started to decline here. What we've really seen is a major spike in the percentage of stocks that are still above their 200-day moving average, but below their 50-day moving average. That's what we've seen a massive spike in. So why is this important? What does this tell you? This tells you that, hey, a large number of stocks are still trading above their 200-day moving average. They're still bullish in long-term trends. But short-term, we've seen a lot of things roll over, okay? This is very common to see in pullbacks in the market, right? When you take a look at this here, when we top out, right, we hit some extreme conditions on this. What's the one that you see start spiking up? Well, you see the orange here start spiking up, okay? And, this is very normal. It's just letting you know as we're going down that stocks are still in a long-term uptrend, but short-term, it's a little bit bearish and we're seeing some type of correction, okay? That's exactly where we're at. We're in a long-term uptrend now that's still valid, that's still intact, but we are seeing stocks roll over and start to decline here on much shorter-term trends. And we look at equity fund flows, we've been seeing fund flows coming out, right? We've been seeing fund flows going down, right? And they actually went negative here. And we're starting to see a little bit of an increase now once again. We're not seeing anything extremely bullish or euphoric, but we did see a sell-off and we did see a massive drawdown in fund flows into negative territory. And now we're starting to see it creep back up a little bit as the market is bouncing here. But this earnings season is really huge. I know people probably say that every time, but we really need earnings to really help justify this, and continue this bull market, in my opinion. The next 2 weeks is basically the most important, right? And it's really going to be a lot of financials and a lot of industrials, right? I know everybody's focused on big tech. Big tech is going to be very important, but financials are also really important. Industrials have been the big sleeper. And what do I mean by that? This is a ratio chart of XLI divided by XLK. So this is showing you the relative performance of industrials versus tech. Now, as this goes down, it simply means that tech is outperforming industrials, which is very common to see, especially given the Magnificent Seven, and a lot of big tech performance that we've seen since 2023 has started, right? But look what started here in 2024 as the year started. industrials have been outperforming tech the entire year. And this is now in an uptrend. And we go through these little phases where we put in some temporary bottoms, and then we start to really go through this phase here where industrials are outperforming tech, right? We saw that 2022 to 2023, right? We're seeing that now, 2024. Is this something that can potentially last another whole year as it did from 2022 to 2023? That's a question you got to ask yourself. And earnings are going to be a big part of that. And it's something that I'm paying attention to right now and keeping an eye on. And I think you should as well. Now, when you take a look at Amazon, Google, Meta, Microsoft, Nvidia, and you take a look at the S&P 500 earnings growth for Q1 of 2024 on a year-over-year basis, this is 64%. 64% is basically all of the growth, okay, that's factored in. If you take a look at the other 495 companies, it's actually at negative expected growth, okay? So Meta, the stock fell, okay? The stock did perform well. It fell because of their CapEx and basically telling people how much money they're spending and how much money they continue to plan to spend into 2025. And then their, guidance wasn't as strong, but they beat, okay? They had an impressive beat. It was really nice to me, in my opinion. But, the stock market was a little more worried about their guidance, about CapEx and, future earnings, right? Google did good today. Okay, we're seeing the stock being rewarded. Microsoft did good, seeing the stock being rewarded. So left, we've got Nvidia and Amazon. These two stocks right here are, after we've already went through the other three, very, very important, guys. Very, very critical for the market. Now, analysts usually set expectations a little bit low. So it'll be really interesting to see, does this negative 6% come in higher here, right? Does it come in at negative 3%? Does it come in at 0%? Or could it even go positive? Industrials and financials, I think, are some areas where we could see some potential bullish earnings results in there, right? And that's where we want to pay attention to. Are those results, are those earnings reports in the other 495 companies, what are those telling us, right? Are those bullish or are those bearish? Now, when you look at ExxonMobil versus Tesla market cap, ExxonMobil is trying to take over Tesla in terms of market cap, right? The age of EVs ends, right? Now, I'm not sure I believe in this. This is something that is a pretty big narrative that's been going on. We'll see how it develops. I don't really have a very strong opinion on whether or not EVs end, right? And it's the absolute end. And I don't really have a strong opinion that EVs are going to be the only type of vehicles that run in the future. To me, it's just not really clear, right? There's some big debates on both sides, and I'm not an expert in the field. So, I just focus on trading and trends. Now, when you take a look at equity valuations, they look less attractive as yields surge. The benefit of owning stocks over treasuries and IG credit has fallen, okay? And this is something that's going to segue us into TLT. Now, TLT, I'm watching, okay? I had to adjust the trend line here because, we had a little bit of a false breakout wick right here. But we do still have my favorite chart pattern of, basically the past year or two. And it's known as an inverse bump and run, okay? If you're new to the channel and you haven't watched my videos and don't know what this pattern is, it's simply when you have a prevailing downtrend, right? That's what this top trend line is. And then you get an aggressive bump down in price, right? We've seen a very aggressive bump down in price. And the run is actually when you break through these trend lines here. And in a perfect world scenario, the inverse bump and run is going to take you back up to where the pattern began, which is going to be anywhere from 98 to about 100 on TLT. Lots and lots of work to be done beforehand. What I want to highlight is we're again back approaching oversold territory here on the daily time frame. Okay, we're also potentially trying to get a bullish crossover on the MACD. I went over how the daily MACD crossovers are very good swing trading signals and have worked for me and worked for others very well over the past 2 years. I'm not in TLT at the moment. I just want to see how this thing plays out. But the big thing I've been mentioning to people is below 89.50 is no good, right? That is bad for TLT. And you may be asking yourself the question, why is that? Well, when you take the lows and you take the highs, right, we had this large move up. And what we've done is we've now broken through the 61.8% Fibonacci retracement. Typically, this is an area where you would see some type of a bounce and a move higher. The more time you spend underneath the 61.8% Fibonacci, the greater the odds are, right? The odds go up of a 100% retracement back to the lows on TLT near 82.50. Now, depending on what side of the trade you're on, you may be rooting for that, you may be rooting against that. But I just wanted to keep people mindful of that. Okay, is that, hey, this is not good. We really need to get back above this 89.50, turn this into a little bit of a scoop and score where we do something like this. Okay, that's what the bulls are going to want to see in bonds. Bond bulls are going to want to see this turn into a scoop and score where we kind of have this false breakdown here. We reclaim 89.50 and break out to the upside. What I'm watching as potential signals, I'm watching the RSI. Okay, we talked about how support 7 times here. We had this shelf, and if we broke through this shelf, it was very likely that we were going to see a flush in TLT. That's exactly what happened. Okay, we talked about the bearish crossover here as well. That's exactly what happened too. Huge sell-off. Now what we're watching is, can we get a bullish crossover on the daily MACD, right? Can we get a nice bullish divergence to potentially help us out? Now, what do I mean by that? Well, take a look here where we have lows on TLT and we have lows on the RSI, right? We're in this oversold territory. And what do? Well, we actually come down and make lower lows here, right? So we make a low, lower lows, but we actually make a low and a higher low here. And this bullish divergence really helped kick off the bullish trend and the bullish, shift that we had in TLT. Okay. So that's what I'm watching for, right? I mean, technically here we have a slight bullish divergence where we kind of have equal lows on the RSI, but we do technically have lower lows. Maybe that was a technical analysis perspective why we saw a little bit of a bounce today. But I wouldn't mind, if this thing even went more oversold, because too many people use RSI wrong, in my opinion. They see something as overbought. They say that, hey, this is extremely bearish. No, that's the exact opposite. This means that this stock has tons of momentum, and maybe it ran up a little bit too fast, but it's very strong at the moment, right? I mean, take a look here, right? We come here, we hit overbought territory. The bears are going to tell you, oh, this is a complete short here. TLT is going to crash. What do? We pull back. We cool off a little bit, right? And what does the RSI do? It goes up more into even more overbought territory, right? And we see a massive breakout. And then what happens? We peak here, right? We peak in the RSI. We peak in momentum, but the stock price continues to go higher. So it goes from like $96 all the way up to 169 after hitting overbought. What happens over here? Over here, we come over here, we hit oversold. What do? We go even more oversold, right? We continue to drop lower, continue to be more oversold, right? That takes us to this point here. Then the RSI bounces, the stock bounces, but what do we end up doing? We end up coming down and making a new lower low. Why? Because this is showing weakness. This is weak. This is not a strong stock. This is not a strong trend, right? And that's exactly what you're seeing, right? So, sometimes you get these little bounces or pullbacks based off of the RSI, such as you see in these areas, but it's telling you where the trend is at. And it's telling you that, hey, this is not a strong trend, right? Even though we're bouncing here, it's still not a strong trend. This is a weak stock, weak ETF. Over here, what are we seeing? Hey, we had a little bit of a bounce here after we were oversold, rejected the key Fibonacci level, 89.50, and we dropped lower, right? And we're still right there around that oversold territory. It's very possible we can do something like what we saw over here, right? We're oversold, bounce, sell off huge again, right? And come down and get deeper into oversold territory, okay? You got to keep aware of the risks, all right? And not everything is a buy signal. What I'm watching for, okay, as I've mentioned, looking to see if we can get a nice bullish divergence forming here. Looking for a daily MACD crossover. Maybe can we break this trend line? If we break this trend line here, I'm a fan of buying some call options, okay? And just putting a stop loss below the most recent lows, and it'll be a very tight risk to reward ratio, right? Maybe be risking 1.5 points on TLT for anywhere from potential 2 to 5 points, targeting just up here, not even targeting the full entire move all the way back up to 169. That's a much, much greater risk to reward ratio if you're targeting the full move. So that's really what I'm watching for in TLT right now. If you take a look at TNX, it's really hard to be bullish on TLT when you take a look at the yields, guys. I mean, the yields yields are popping. Yields are literally popping. Okay, they're going higher. We talked about the cup and handle that was present here. Okay, there was a cup and handle. We had a little bit of a breakout, check back of the top of that cup and handle, and we just completely fired off. And what did I say in the last video? We're bull flagging here, guys. We are bull flagging on the TNX, on the 10-year treasury yield, right? We're creating this bull flag. If we break out, that's potentially going to send us above that 4.70 area and head us up towards here, towards 4.78 to fill the gap. Okay. Remember, gaps tend to fill about 90% of the time historically. The big question is when, right? When do they fill? Okay. And if we come back over to TLT, look what we've got down here. Not very far away, about $2 away, 2 points away on TLT. A gap down at 85.26 to fill. Look how close we are to filling the gap up. So if the gaps are going to act like magnets, we could continue to see the 10-year treasury yield come in higher, right? Something that could cause that to happen very, very soon is if we get a hot CPI or a PCE report. If we get hot inflation numbers and hot jobs numbers tomorrow, Friday, we could see these gaps fill like right now, right? We could see the gap down fill. We could see this gap up fill. Okay, that's something that you need to keep in mind and a risk you need to be aware of, right? Now, if they come in soft, these are very good rollover moments, right? It would be very nice to see TNX roll over here on some soft data, yields start to decline, and TLT potentially get that MACD crossover and break this first trend line here and be able to reclaim 89.50. So I think patience is best right now. All right, use the technicals to your advantage. Just be patient. Wait for some of these different signals to occur. Wait and watch. Okay, cash is a position. You don't always have to be forcing a trade or being or feeling like you always need to place a bet on whether bonds, stocks, ETFs, commodities are going to go up or down. Right? Sometimes you need a little bit of clarity. Right? And you can save a lot of money not burning money, feeling you constantly need to make a bet every single day or every single week on direction, and really just let things play out until it's much clearer. All right, that's my advice, my opinions on how to navigate this market, and hopefully you guys enjoyed today's video. If you did, remember you can join the Investment Intelligence Discord using that link in the description down below. All right, many great plays have been in the Discord. Okay, I got very lucky, just so happened to time it in the October bottom of 2023, right when I launched the Discord, and it's been great plays, great setups. We've been nailing the shift in markets. Okay, when the market shifted towards energy and we saw a lot of these, before we saw a lot of these tech stocks pull back, I was not interested in longing tech. I was looking at commodities, got over 100% on commodities, over 100% on energy. You can sign up for the newsletter. That's completely free if you don't want to join the Discord for $10 a month. And if you enjoy my analysis or you ever want a one-on-one coaching session, there's a link in the description for my Ko-Fi page. In there, you just simply click on the commissions tab and you can book a 30-minute, 1-hour session, whatever you would like. There's a buy a coffee button if you want to leave a tip or donation for the free valuable content I put out, such as the newsletter and the YouTube videos. And if you ever want to request a specific YouTube video on a topic of your choice, feel free to do that through the Ko-Fi page. Okay, that way it doesn't get lost in the comments and I can actually see it and make it a priority for you guys, my much appreciated viewers. Thanks again for watching. If you enjoyed today's video, I really think that you're going to enjoy this next video here as well. So be sure to click on that one.